Okay, let's talk about the market data. The Fed raised 25 basis points. The market obviously has ripped since then. The jobs data this morning was crazy. We added 517,000 jobs, more than 2x December, and well above the estimates of 188,000 jobs. The Fed, I think, is starting to realize they can obviously impact inflation and slow down speculative assets, but they're having a very hard time with the labor market. Obviously, labor participation actually is growing. We've talked about that many times here. It's bumped up to 62.4%. We all know it peaked at like maybe 69% during the 2000 time period. Wage growth, though, continuing to slow. So that is some good news there. And obviously, risk-on assets are ripping the last couple of days. Chamath, what's your take on where we are with the market and the Fed's action, which people are starting to believe will be another 25 basis point hike and then maybe staying high for the rest of the year? Did you hear their comments? You think dovish? What's your take on the market?
I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 225 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going.
Here's the Fed fund rates chart from 2000 and into the 2008 recession. And you see just, you know, to Chamath's point, in 2019, that little step up to 2%, and then this dramatic step up that we've been on up to 4.5% or so. Sacks, is this where the Fed pauses? Do you think they cut? And what overall effect is this going to have on venture capital and the startup market, which is super important to us?
I think we're in the whipsaw economy here. Just a month ago, sentiment was incredibly negative. On this show, we were predicting for the year that we were looking at the Fed funds rate going from 4.5% to say 5.5%, 250-point increases. The belief was that we were going to have a recession later this year. I think that was pretty much consensus. And now, 3 weeks later, you had a situation in which we got a couple of really good inflation reports. So all of a sudden, the consensus changed to, we're not going to need to raise rates, to 5.5%. Maybe we only get 1 or 2 more quarter point rates. And the market just ripped on the belief that inflation was in the rearview mirror. The problem had been licked, and now we can just kind of move forward. And the Fed seemed to confirm that just yesterday with a quarter point rate increase. And now today, we have this wild jobs report with over 500,000 new jobs. The expectation was only 100,000. And so now all of a sudden people are wondering, well, wait a second, does this mean that labor costs are going to, go back up, that the economy is overheating, and now the Fed's going to have to raise more? So I would say literally from week to week, we're being whipsawed between expectations of whether inflation has been conquered or not, whether the economy is going to have a recession or not. And I think probably where we're sitting at this moment is you'd have to say that the risks of inflation returning are slightly higher, but the risks of a recession are slightly lower because with this kind of jobs report, better chance of having a soft landing here.
It's very hard, in other words, Sacks, to have a recession if people are employed. If people are employed,
well, especially
and we have
when you're down to 3.4%. Yeah, exactly. So
50-year low.
Right. So I just think that we're in a highly volatile economy and it's very hard to predict the future. I'd say that relative to where we were a month ago, you'd have to say that the odds of us having a soft landing this year are quite a bit better than they were just a few weeks ago.
All right, Friedberg, when we look at this employment picture, it does seem people are going back to work. Seems maybe indicative of people blew through their savings. We talked about this. You've been harping on and on previous episodes about people doing personal debt, buy now, pay later. Is a possible thesis here that people YOLO'd for so long, post-pandemic, Coachella, vacations, etc., that maybe they whip through their savings? It seems like we've burned off $1 trillion in savings or something like that, and the debt's going up. So now people maybe need to go back to work, and they're finally capitulating and taking jobs. Do you think that's what's actually happening here?
I don't know if I would classify that. I mean, there's obviously a lot of this stuff is on the margin. The one challenge, Larry Summers has been harping on since last spring, all the way through the summer and the fall. And, in multiple kind of interviews and publications he's done, he's the ex-U.S. Treasury Secretary, obviously brilliant economist, that the U.S. needs to have a 5 to 6% jobless rate for 5 years in order for us to really get to the inflation rate target of 2 to 3% or below 2%. And so, the economists and the macro guys that are tracking their jobs report today I think the indication is we're not there yet. And that the implication of a tight job market is wages go up, and wages go up, inflation goes up, and because companies need to charge more because they have to pay more to get talent. And this obviously continues to support the escalatory spiral that drives inflation. So that's the kind of downside to the jobs report today that I think a lot of folks are watching.
The Fed mentioned over and over again deflation. So any impact there, Chamath? You think we're going to see prices start to crater? And what impact would that have on the market?
I think Sacks is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. There's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend. Because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh, and really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw, as Sacks says.
When you say book build, you mean trying to see if you'll get some early takers to buy equity in an IPO perhaps even in a company like Stripe that's been sitting on the sideline?
So not Stripe, they're in a complicated moment. But when they call to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think? Where's the price? Blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again.
Would there be an appetite in your mind for an IPO in the second quarter of like a Stripe type company? Putting, I don't know what the other candidates are, the lead candidates, but Stripe is the one people talk about most.
The thing that we have to think about is like most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. And similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30 to 60 days.
Yeah, I was about to get to that. Yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is, what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. And Powell was clear, and it's true. We're in a deflationary cycle.
Well, he said deflation 11 times during his, he's very clear about his use of language. Yeah.
That's why the market ripped. I mean, basically, that was all part of a narrative where inflation's on its way out. We've licked that problem. And that's what the market was pricing in. And I think now the question is, in light of today's jobs report, is that actually true or not?
And I'm sorry, disinflation, not deflation.
Disinflation, yeah.
Disinflation.
So I think, one way to look at this is, Jake, how you showed the chart of the Fed funds rate. Another chart is the yield curve. Can we just pull up the yield curve for a second? This is the yield on U.S. Treasuries, on, RT bills. And one way to look at this is as a prediction market of where the market thinks interest rates are going. Because the Fed sets the rate for the Fed's funds rate, which is the overnight rate of lending to banks. But they do not set the rate of, 3 months, 6 months bonds, 10-year bonds, and so on. The market does, because the market trades those bonds and it imputes a yield that the market requires to want to hold those bonds. So what's interesting is that if you view the yield curve as a prediction market, it tells you at any given time what the collective wisdom is of the market. Now, this thing is fluctuating, moving all the time. So that collective wisdom is changing. But where things are today, it's pretty interesting. It looks like what the market is saying is that within the next 6 months, the rate peaks at 4.75%. So, Nick, if you just want to hold the mouse on the 6-month dot, you'll see it's 4.76%. So basically, the market is predicting we get maybe one more quarter point, roughly. Not much. And then if you go to the 2-year, it's at 4.09, so a little over 4%. So what the market is actually predicting is that over the next 2 years, we're actually going to get a 50 basis point decrease from the Fed. And then if you go to, say, the 5-year or the 10-year, we're at 3.5%. So the market's basically saying that long-term rates are going to stabilize at 3.5%. We're not going back to the abnormal zero interest rate policy or ZIRP that they had for 10 years. 3.5% will be the long-term stable, cost of money. But you can see that the market, the prediction market, thinks that the Fed has done enough to combat inflation because the Fed funds rate now basically is where the bond market thinks it should be. And in fact, the bond market thinks it's coming down over the next 2 years.
But coming down to what would be 3.5 in a world that we've lived in for largely over the 14 years of this bull run, the majority of that was at close to zero or zero.
Right. And that's why we're never going back to the bubble of 2021 where SaaS companies were trading at 100 times ARR. We're going to go back to an environment more like a more normal one where valuations are more like the 2017 valuation, something like that. By the way, it's 3.5% is not a bad.
It's still a great deal. Still a great deal if you got your mortgage at that.
If you listen to Buffett's teacher, this guy, Ben Graham, in Ben Graham's book, the way that he would look at a stock, and obviously, look, things have changed, but the way that he would look at a stock is he would look at that risk-free rate, he would double it, and then the inverse of that is the maximum price to earnings ratio that he would pay for a stock, right? That's the trade-off is if you can get more than 2 times the risk-free rate, then it's worth owning a company. What that means is that if you take 3.5% as a terminal rate, the right PE is around 14 for the S&P 500. Right now, the S&P 500 trades at 22 times PE, which would mean that we are 50% overvalued. Now, that again, that's a Benjamin Graham model, and I think the world has pretty cleanly moved away from it. But there's probably some rooting in that intellectual framework that's still valuable. And to your point, David, it just reinforces that, man, we need to start to learn a new regime here, because when rates are not zero, there's just a lot of excess that you can't support because the alternative trade-offs for investors are plentiful, and plowing money into a money-losing startup becomes less attractive.
And to just give people some background, that's The Intelligent Investor was that book, I believe. And he was talking about value investing, which is, hey, what's the earning per share? What's the ratio? What's the PE? And that's something that growth and momentum investing has been the opposite of. And this is a